stocks having a little trouble finishing strong. Nvidia's back red. Bitcoin's now red again, too. So the only thing holding it together is the Russell 2000 and a couple energy stocks. Joe Mazzola and Collin Martin are with me. Joe's the director of trading and education. Collin's the director and fixed income strategist. All right, it's the anti-beta week, Joe Mazzola. I mean, look, we're not down big, but we're not up, and that's a new thing.
We're down 10 basis points in the S&P 500. It's I mean, I think when you get accustomed to having weekly gains and you get a little bit of choppiness like we have this week, I think it's the rotation that's probably you're feeling that a little bit more, Oliver, than maybe just a pullback overall in the markets. And look, I mean, on the short end, right, as opposed to like a 200-day moving average, if you look at the 50-day moving averages, I mean, there's been some damage to IT done this week. Only about 64% above the 50-day, and we were in the high 70s just a couple weeks ago. But where that rotation has occurred, where that money's going, your prior guest was talking about that to a certain extent with energy and materials. Energy right now, 96% of the components are above their 50-day moving average, and materials just below that at 89%. You guys were talking Southern Copper, and copper's been on the move, as have some of the other materials and some of the other energy names, and that's where the money's flowing right now. You're still seeing equity inflows. That was kind of brought to our attention. Bank of America early in the day made that announcement, but it's just where are they going? And at this point, it looks like they're looking for other opportunities.
Rotation versus sell-off is a really good point. I like the way you framed that, Joe, because those are two ways that we don't go up as much, right? And one is preferable to the other. As far as bonds go, Collin, it seems like it's a little bit more binary. Either yields go up, yields go down, and they move pretty quickly in either direction.
Yeah, we've definitely seen that over the past few weeks. We saw a sharp decline where expectations came back down a little bit, and then just over the past week or so, we saw a really big jump in Treasury yields. Just this week alone, from 2 through 10-year Treasuries, we're seeing yields up 20 basis points or more, and the 2-year is at its 2024 high. It all comes down to the inflation outlook and inflation data that we saw this week, whether it was CPI, PPI, or even today's import price index. The theme was pretty much the same. We saw February's numbers coming off the hot January readings, but still coming in a little bit higher than what the 6 or so month trend has looked like. And that's sort of spooked the markets into thinking that maybe that first rate cut gets pushed back a little bit. At this stage, it looks like May is pretty unlikely right now, and more June or July. It's going to be really interesting taking a look at next week FOMC meeting to see what their economic projections show, and specifically what that dot plot shows. Because coming into the year, the median projection suggested 3 rate cuts. The markets are still in line with that, but it'll be interesting to see if that gets revised down a little bit to 2 cuts or less.
So at this point, I tweeted something earlier today like there should be outrage if dots move down in the next reading. I'm not saying they necessarily have to move up, but like they shouldn't go down, should they, Collin? But I mean, like, how could they justify that?
Yeah, down meaning a lower rate
lower
at
rate.
The end of the year.
Yeah, exactly.
Yeah. Oh, I mean, I'd say there's no way we do that. So there's no way the rate goes down. If anything, the number of cuts goes down.
Right.
But I think it's gonna be a difficult decision. If you look at what the Fed's projections were in December, not just the dot, but their economic projections, we're pretty close, or it looks like we're still kind of on pace for that. Unemployment rate of 4.1% was their projection. We're at 3.9. Oh, that's been choppy. And 2.6% was the Fed's core PCE projection. We were at 2.8%. Now, if we were to stall at 2.8% over the next number of months, that'd be cause for concern. But it seems like the trend does seem lower, and it'll be really interesting to see how much just January and February, if and how much that spooks officials into pushing back and upping their expectations for where they see the Fed funds rate at the end of this year.
Okay. The thing so far for stocks has been that they don't really care, Joe, about rate cuts, evidently, or rates generally, except for maybe that Russell. Maybe that's why that big breakout got stopped out. So it's like group and sector and size, maybe some, but do we have any reason to believe lowering the odds of further cuts would kill the bull market?
You know, I'll be watching the summary of economic projections, the dot plot next week, fairly closely, and I think investors will too, because I think that maybe the dialogue that comes out and the dots, if they do show that maybe there's a move towards 2 cuts as opposed to 3, maybe that's the consensus. I do think that could weigh on stocks a bit. I mean, Oliver, I think what we have to think about is this is one of the most elongated cycles that we've seen in a long time. I mean, the distance between the last hike, versus to where this first cut, could potentially be. I mean, we're on the doorstep, on the precipice of one of the longest cycles ever between those two time periods. So, I mean, look, within all of that time, you haven't had the S&P decline by more than 2%. In a long time, we've got an inverted yield curve that's coming on the precipice of longest ever. So there's a lot of things for stocks to digest. I think what they've been digesting recently is a pretty favorable earnings cycle. And that's going to kick off with the next couple of weeks as well, too. So there's a lot for markets to be able to kind of really reprice off of in the next few weeks. But a lot of it kicks off next week with the dot plot.
All right, absolutely. For sure. Going to be fascinating to see how much they've responded to recent data. Thank you very much, guys. Collin Martin, Joe Mazzola. A wrap of the weekend to look forward to.